Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Crit Thomas, global market strategist with Touchstone Investments, to discuss what the canary in the coal mine is in the market and how to position in a volatile environment. Crit, it's great to have you with us. Welcome to Trade Talks.
Thank you. Glad to be here.
Let's talk about credit. We've been hearing about that quite frequently. How does credit act when economic growth is in question?
Right. So the question has been coming up as to whether we might be tipped into a recession later this year. And so the VIX index for the S&P 500 has moved up quite a bit, which does suggest some stress. But typically, I like to look at the credit markets, and mainly it's just because the credit analysts tend to be a bit more risk averse. And so, what they're seeing typically gets reflected and holds a little bit more sway with me in terms of how to interpret the markets. And yes, credit spreads have widened out, but not to a level where I'm seeing stress. And even they widened out a bit yesterday. They're coming back today, but still, we're near the lows of where we were at over the course of the last cycle. So at this point, I'm not seeing anything that would suggest the kind of stress that you would see that would indicate that there's a recession on the horizon. And that would not be my base case either.
Crit, let me follow up with a credit 101 question. What does it mean when credit spreads widen? Why do investors look at that?
Sure. So first of all, what is a credit spread? And that's basically the additional yield that you get on top of a duration equivalent, a maturity equivalent Treasury bond. And so it's the additional income you're getting for taking that corporate bond risk. And so when that spread widens, that just means you're getting compensated even more for taking that risk. And as it widens, that suggests that there's some concern out there.
Right. So if credit markets are right and the economy is not headed for an unexpected downturn, then why do equities seem so spooked?
So it's a good question, and I think part of it just has to do with the squeeze that's going on in terms of margins. And so one of the things that I've been paying attention to is profit margins for the S&P 500. And since we have recovered from the pandemic, there's been a massive move in terms of profit margins for the S&P 500. We're at all-time highs, and by like 300 basis points over the last peak, which was back in 2019. And yet you have the producer prices was out today. It was a really strong number. So you have these input costs that are big. You have a really tight labor market. So that also creates some strain. Yes, companies have been able to pass through price increases, but for how much longer? And if you look at the consumer out there, if you're paying more for gas, if you're paying more for food, that means that's less money you have to spend on other things.
So what do you do then? Hide in treasuries?
I don't think you hide in treasuries, and mainly because there's such a huge gap in historical context between treasury yields and where inflation is. And it doesn't matter whether you use a 10-year or the 2-year, it's a dramatic gap, and you can go back all the way to the 1960s. We've never seen anything like this. To me, that suggests that there's a degree of confidence in for those that are holding treasuries right now at these really low yields, despite the real high inflation rate. So I don't think that's the place to go at this point. And market prices have come down, so I think that there's some opportunities that are starting to crop back up within the equity market.
So, Crit, to wrap up here, what are you recommending in this environment?
So, I think there is a need for some caution, but I am seeing, as I mentioned, some opportunities. If you look at the S&P 600, so that's the small cap index kept by the Standard & Poor's, we're basically near the lows that we have seen historically on a forward PE basis. Now, maybe earnings might come down because of some of these profit margin squeezes, but they'll also come down for larger cap stocks as well. So I see some safety in there just from a valuation perspective. And so that's sort of where I've been at. And also, the larger cap stocks with the larger PEs, there's still risk if interest rates continue to move up just from that standpoint as well.
All right, Crit, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Certainly. Thank you.